edition of the CNBC-TV18 Investor Camp. I say special because after traveling far and wide throughout the year, all over the country, today we are in our own city, the city of Mumbai. Of course, the retail investors and the audience here does not need any tips on how to invest. In fact, I hope to learn a thing or two from our audience over here. But it's a good time to be in the markets now because the Sensex once again has resumed its uptrend above the 27,000 mark. We've seen emerging market flows come back after very many weeks. And even as far as earnings season is concerned, it's not been so bad with good earnings coming in from the likes of Reliance, Infosys, IndusInd Bank, etc. So we're going to take you through what you should be doing now in such a scenario. We have a range of experts here from technical to fundamental. But before that, let me welcome my co-anchors as well. Anuj and me have been traveling the length and breadth of the country. But today, we have a very special guest. That's you.
Okay. Well, hardly. I'm the hostess here. But it's a pleasure being in Mumbai and reaching out to viewers, which we don't always get an opportunity to. The investment culture started in Mumbai. Mumbai is the capital of finance and investment. So it's very difficult to teach a thing or two.
All right. Well, let's now talk about what we're all passionate about, right? The markets. Anuj, the markets have got their mojo back, it seems. I mean, 3,000 crores of inflows in the month of October already. Global cues are stable. We've seen 3 weeks of gains. What's happening?
I think over the next 1 week or so, this is the real test of the market, because if the market has to reverse, it has to reverse from here. 80 to 50 thereabouts. So that's the sense you get, that if this is a counter trend rally, big counter trend rally, then it will stop somewhere between now and the 200-day moving average, which is around 8,400.
All right. Well, on that note, since it is a great time to be investing in the market, let's invite the first speaker on board. He's someone who's had more than 25 years of experience in the markets, and he has a very easy and intelligent style of investing. So let's put your hands together for Nilesh Shah, the MD of KOTAK MAHINDRA Mutual Fund.
We are neither gifted, nor talented, nor committed like Tendulkar. How can we expect that all our investments will go for a 4 and a 6? So that's why you need to invest for long term. Neither we are Tendulkar, nor we are gifted, nor we are talented, nor we are committed. Hence, give time to your investment. Be a long-term investor, do SIP, do asset allocation, and I'm sure it will work wonder for you. If economic, financial, monetary consideration doesn't make sense to you, think about this. Today, we are in a phase where we have seen Indian GDP growing from $275 billion in 1991 to about $2 trillion in 2015. It's a jump of about $1.8 trillion, and that's reflected in market cap, which has grown up by $1.35 billion. In that period, we have seen companies like Infosys, Dr. Reddy's, Sun Pharma, Axis Bank, KOTAK Bank, all kinds of great companies creating value. Now, it is estimated that somewhere between 2015 to 2024, we'll end up doubling our GDP from 2 trillion to 4 trillion. It's a growth of about $2 trillion. Almost equivalent to what we have witnessed between 1991 to 2015. Now you can take a call, with this growth in GDP, how much growth will happen in market cap? Now these are the compounding of stocks between 1991 to 2015. If you had 10,000 rupees invested in 1991 in this stocks or Sensex, Sensex has multiplied to 2,23,000. Gold has multiplied to 1,05,000. And there are stocks like Wipro, which has multiplied from 10,000 to become 1.75 crore. These are all the companies which you and I all knew in 1991 that they are good companies, quality companies, blue chip companies. Some have delivered great returns, some have delivered mediocre returns, some have delivered reasonable return. I don't know how many of these stocks are with you. Tomorrow, let's say we go to 2025 or 2035, you'll have similar range of stocks, and your kid can come and ask the question, Papa, why didn't you invest in these stocks? If you had invested, probably I would have retired rather than continued working. What will you answer them? in front of us, we have an opportunity to participate in similar wealth creation which happened between 91 to 2015 over next 5, 10, 12 years. Grab the opportunity. We are seeing a lot of parts of domestic India which is now grabbing that opportunity. There are 80 lakh smart Indians who are doing SIPs. They bring between 30 to 35,000 crore in equity mutual funds through SIP every year. I just hope and pray that that tribe increases. One, there is selfish interest because I manage money for them. But second, there is a noble interest that they will all become richer. We believe over next 5 years, demand for equity from domestic investors will be higher than the supply of equity. Mutual funds last year bought 65,000 crore. We expect them to deliver about 3,50,000 crore into the market if you continue to support us. LIC has been buying 50,000 crore equity a year. Without creating any growth, they'll bring 250,000 crore in equity market over next 5 years. Provident Fund and EPFO, they are not allowed to invest in equity market till last year. They've started taking baby steps in this year. Over next 5 years, we expect them to bring about 200,000 crore into market. Private insurance and banks were net sellers last year because of ULIP redemptions. Going forward, hopefully they'll bring about 100,000 crore into the market. So the domestic institutional investors between mutual funds, life insurance and EPFO and other exempted provident fund trust will end up bringing 900,000 crore into the market. We think that's going to exceed the supply which could come into the market. Now if domestic and FII both starts buying, you can imagine what will happen to the prices. When you're looking at buying equity, do keep this advertisement in mind. It's the advertisement for Patek Philippe watch. The tagline is, you never actually own a Patek Philippe. You merely look after it for the next generation. So buy equity in this fashion, give it to your next generation, and I'm sure they will thank you for making a wise investment. The other thing, if monetary considerations don't appeal to you, think about this as a nationalistic movement. Today, 25% of Indian equity market is owned by foreigners. About 9% of Indian equity market is owned by foreign direct investors. If I round it off, about 35% of Indian equity market is owned by foreigners. 65% is among us. Of that 65%, a large portion is owned by the Indian promoters, not the retail individual investors. The retail investors own no more than 8% of the equity market cap. Do you think we can retain our economic independence if the ownership of Indian equity is with the foreigners? I think it's important for us to retain Indian equities ownership with Indians, and hence it's important to join this movement of owning equity. The future depends upon what we do in the present. In 20 years, we have given up 35% of Indian equity to foreigners. You have some time now to reverse that trend, and hence it's important to own equity. Mutual fund investments are subject to market risk. Please read scheme-related documents carefully. Past performance is no guarantee of future performance. Finally, take this 3 bandars, Gandhiji's Priya Bandar, to your home. Don't look at daily market movement. Don't bother about hype and noise. Don't go for tips. Be a long-term investor. Be a regular investor. And maintain an asset allocation. I'm sure these are good recipes for becoming wealthy. Thank you.